Your investment might be worth millions. But what if you can't get your money out? What happens when everyone wants their money back at the same time?
Private credit panic, why investors are rushing for the exits. Imagine putting your money into an investment that promises attractive income, relatively stable returns, and protection from the daily chaos of the stock market. You don't see prices moving every second. You don't watch a company's stock crash 20% in one afternoon. Everything looks calm. But then something changes. Investors start asking for their money back. More investors follow. And suddenly, the biggest question isn't how much the investment is worth. It's whether you can actually get your money out. That is the uncomfortable story developing inside the private credit market in 2026. Private credit has grown into a massive part of the financial system. But now, rising defaults, troubled loans, valuation concerns, and redemption pressure are forcing investors to take a much closer look. And this raises a much bigger question. Is private credit facing a temporary correction, or are we watching the beginning of something much more dangerous? Welcome to BIN Invest ***. Today, we're breaking down the private credit panic, why investors are rushing for the exits, and what could happen next. Part 1. What exactly is private credit? Before we understand the panic, we need to understand the business. Private credit is basically lending, but outside the traditional banking system. Instead of a company going to JP Morgan, Bank of America, or another traditional bank for a loan, it can borrow directly from private credit funds and other non-bank lenders. For investors, the attraction is obvious. Private credit can generate relatively high income. And for companies, it can provide financing without going through the traditional public bond market. This model exploded during the era of extremely low interest rates. Money was cheap. Investors were desperate for yield. Private equity firms were doing more deals. And private credit funds stepped in to finance those companies. The industry expanded rapidly. Today, private credit is measured in the trillions of dollars. And for years, the story looked almost perfect. Investors received attractive yields. Borrowers received capital. Fund managers collected fees. Everyone seemed to win. But there was one problem. The system had never really experienced a full cycle of serious stress. Until now. Part 2. The first warning sign, borrowers are struggling. Here's where the story becomes interesting. Private credit loans are not risk-free. Many borrowers are middle-market companies. Some operate in industries that are highly sensitive to interest rates, economic growth, or technological disruption. And a lot of companies borrowed heavily when financing conditions were much easier. Now the environment is different. Borrowing costs are higher. Refinancing is more expensive. Business growth has slowed for some companies. And interest payments are becoming harder to manage. Recent data shows that troubled loans inside major publicly traded private credit vehicles have risen significantly. The median share of loans on non-accrual status among 20 large BDCs reached about 2.8% in the second quarter of 2026, up from around 2% just 3 months earlier. Non-accrual basically means the borrower isn't making the expected interest payments. And that's important. Because when a borrower stops paying interest, the investment may no longer produce the income investors expected. But there's another problem. The reported default number may not tell the entire story. Some analysts argue that certain forms of restructuring, selective defaults, or other credit problems can make the headline numbers look healthier than the underlying situation. That means investors are increasingly asking, how bad are these loans really? And that question leads directly to the next problem. Part 3. The liquidity problem. This may be the most important part of the entire story. Private credit loans are, by definition, private. They're not traded like Apple shares. They're not as easy to sell as a treasury bond. If a private credit fund owns hundreds of loans to private companies, selling those loans quickly can be difficult. Now imagine thousands of investors suddenly want their money back. That's where liquidity becomes a problem. Some private credit vehicles offer investors periodic redemption opportunities. That sounds convenient. But there's a mismatch. The investors may expect relatively regular access to their money. Meanwhile, the underlying loans can take months or longer to sell. It's like promising customers that they can withdraw cash from a bank account while most of the bank's money is locked inside long-term loans. As long as only a few customers want their money, everything works. But when everyone wants out at the same time, the system gets tested. S&P Global has specifically highlighted this liquidity mismatch, noting that redemption limits at semi-liquid private credit vehicles have become a growing focus for investors. And this is exactly why redemption requests are getting so much attention. Part 4: Why are investors rushing for the exit? The answer isn't simply that everyone suddenly believes private credit is worthless. It's more complicated. Investors are worried about three things. Number 1, credit quality. If more borrowers stop paying, portfolio values can fall. Number 2, valuations. Private assets don't have a constantly visible market price. Their values are often estimated using models, comparable transactions, and manager assessments. That creates uncertainty. And number 3, liquidity. Even if the underlying assets are eventually worth something, investors want to know whether they can access their money today. This combination can create a dangerous psychological cycle. One investor requests a redemption. Another investor sees it. Then another. Soon, investors aren't just evaluating the assets. They're evaluating everyone else's behavior. And that can turn a manageable problem into a much larger liquidity event. Goldman Sachs noted earlier in 2026 that high-profile defaults, valuation concerns, and exposure to software companies vulnerable to AI disruption had contributed to a surge in redemption requests. That last point is especially interesting, because technology may be creating a new kind of credit risk. Part 5: The AI problem. Think about what happens when you lend money to a company based on its expected future earnings. You assume the business will continue generating enough cash to repay the debt. But what happens when technology suddenly changes the business model? That's one concern surrounding parts of private credit. Some private credit portfolios have significant exposure to software and technology companies. These companies were once considered attractive borrowers because they had recurring revenue, strong growth, and valuable intellectual property. But artificial intelligence is changing the economics of some software businesses. If AI makes certain software products cheaper, easier to build, or less necessary, some companies could face pressure on revenue and margins. And if those companies already have significant debt, the problem becomes much bigger. Because debt doesn't disappear just because the business model changes. Interest still has to be paid. Principal still has to be repaid. And refinancing still has to happen. That's why investors are paying much closer attention to the quality of the borrowers underneath these private credit funds. Part 6: The 5% problem. Now let's talk about something most investors don't think about. Redemption limits. Many private credit vehicles don't allow unlimited withdrawals. Instead, they may have quarterly redemption caps. For example, a fund might allow investors to withdraw only 5% of their shares during a particular period. That sounds reasonable, until redemption requests become much larger. Recent analysis has shown that some non-traded BDCs experienced redemption requests well above the limits available to investors. And that's where psychology changes. Imagine you invest $100,000. You suddenly become worried. You request your money back. But the fund says, "We can only process part of your request right now." You haven't necessarily lost your money, but you have lost something investors value almost as much: certainty. And once investors lose confidence in liquidity, they start asking harder questions. How much cash does the fund really have? How quickly can the assets be sold? How are private loans being valued? What happens if defaults increase? And what happens if even more investors want out? Part 7: Is this the next 2008? This is where we need to be careful. The internet loves dramatic headlines. Private credit is the next subprime. Another 2008 is coming. Everything is about to collapse. But the reality is more complicated. Private credit absolutely has stress. But that does not automatically mean the entire financial system is about to collapse. Some analysts argue that today's problems are concentrated in specific areas rather than being a systemic crisis across the entire private credit market. And there are still major institutions putting money into the sector. In fact, some insurers and large institutional investors are planning to increase their private credit exposure because they can tolerate longer holding periods and are attracted to certain forms of credit. That's an important distinction. The problem may not be private credit is dead. The real problem may be not all private credit is created equal. Part 8: The winners and losers. If the market continues to experience stress, we could see a major separation between strong and weak managers. The strongest funds may have better underwriting, lower leverage, higher quality borrowers, more diversified portfolios, better liquidity management, and stronger relationships with institutional investors. Weak managers may face the opposite. Poor quality loans, concentrated exposure, borrowers struggling to refinance, and investors demanding their money back. This could create a Darwinian moment for the industry. The private credit boom rewarded growth. The next phase may reward discipline. And that's a huge shift. Because during a boom, everyone looks like a genius. It's only when the cycle turns that underwriting quality becomes visible. Part 9: What happens next? There are several possible scenarios. The first is the soft landing. Defaults remain manageable. Managers restructure troubled loans. Redemptions stabilize. Institutional investors continue providing capital. And private credit survives the correction. The second scenario is a deeper credit slowdown. More borrowers struggle. Loan valuations fall. Returns decline. Investors become more selective. And private credit funds have to accept lower growth. The third scenario is the dangerous one. A major wave of defaults happens at the same time that investors demand liquidity. Funds are forced to sell assets. Those sales push valuations lower. Lower valuations create more investor concern. More investors request redemptions. And the cycle feeds itself. That's the scenario everyone wants to avoid. But right now, there is no certainty that it will happen. Part 10: What should regular investors learn? Here's the most important lesson. Don't judge an investment only by its yield. A 10% return can look incredible until you discover why you're being paid 10%. Higher returns usually come with higher risk. And liquidity is part of risk. If an investment promises attractive income but makes it difficult to access your capital during stressful periods, you need to understand that trade-off before investing. The second lesson is diversification. Don't assume that because an investment isn't traded on the stock market, it can't experience a major loss. And the third lesson is transparency. Know what you actually own. Know who owes the money. Know how the assets are valued. Know the redemption rules. And understand what happens when investors want out at the same time. Because in a financial crisis, the question isn't just, what is my investment worth? It's also, can I actually turn that value into cash? Conclusion: The private credit test. Private credit isn't necessarily collapsing, but it is being tested. After years of rapid growth, the industry is entering a period where borrowers, lenders, fund managers, and investors are being forced to confront something they haven't faced at this scale in years. What happens when easy money disappears? The current stress is exposing weak borrowers. It's testing valuations. It's testing liquidity. And most importantly, it's testing investor confidence. Some investors may continue moving toward the exits. Others may see falling prices and attractive yields as an opportunity. That difference in opinion is exactly what makes markets work. But one thing is becoming increasingly clear. The era when investors could simply chase yield without thinking deeply about liquidity and credit quality is coming to an end. The next phase of private credit won't be about who can lend the most money. It will be about who can survive when the borrowers stop paying. And that's why 2026 could become one of the most important stress tests private credit has ever faced. If you want to understand where money, credit, and the economy are heading next, make sure you're subscribed to BIN Invest ***. Because the biggest financial risks usually don't become obvious when everything is going up. They become obvious when everyone suddenly wants out. This is BIN Invest. Stay informed, stay disciplined, and never chase yield without understanding the risk.